Welcome back to your weekly market outlook. This is for the 7th to the 21st of April 2023. Let's get started with a recap of the previous week, which is a very interesting week. So we've got the market coming out from the Easter holidays, and then we have that high impact inflation numbers coming out from the US. So let's talk about the US economy first. So we have the US CPI numbers. The drop was from 6% to 5%. This is way lower than what the market was anticipating. Market was actually anticipating between 5.1 to 5.2%. So we do have that drop below consensus, and that's a full percentage drop, and this is basically the single biggest drop ever since the inflation number has come off in the US. And in terms of the headline inflation, we saw that drop. A month-of-month inflation, we also saw the drop from 0.4 to 0.1%. Core CPI have a slight drop on the monthly numbers, 0.5 to 0.4%. This is as per consensus. And also, for the year-on-year core CPI, we actually saw a little bit of an increase from 5.5% to 5.6%. So this is stating that the underlying inflation is in fact still rising, although the headline inflation does drop. And right now, obviously, the headline inflation is lower than what the core inflation is doing. So the core inflation is definitely going to be the main focus going forward in the future. Following the CPI numbers, we also have the FOMC meeting minutes. This causes a little bit of a pause from the CPI drop on the USD. Because there are a few statements that's new and from the FOMC meeting minutes. A few words are being changed from the press conference. We now have more information that the FOMC could potentially increase their interest rate target. Right now it is scheduled for one more 25 basis points hike, and then it will hit the ceiling as explained by the dot plot. So this ceiling, it might get adjusted a little bit higher, potentially towards 5.5 or 5.75 basis percent for this year. So in terms of the sentiment of the market, it is a little bit unique because the market pre and post CPI were kind of anticipating or speculating that there's going to be an interest rate cut in 2023, and that's basically the story going forward that causes the pressure on the US dollar. And there was that anticipation that with such a huge drop in the inflation numbers in the US, the FOMC does not need to hike interest rate in May. That's definitely about to change as we go on through the weeks. We've got the PPI numbers as well. The PPI numbers was also negative. We've got the PPI numbers for the month. Monthly PPI numbers, it was down from 0% to negative 0.5%. Core PPI was down 0.2 to negative 0.1. The year-on-year PPI, it was a huge drop from 4.9 to 2.7%, beating consensus of just 3%. So we saw another huge drop on the PPI numbers, and then comes the retail sales number at the end of the week, as well as the preliminary UOM consumer sentiment. Preliminary consumer sentiment was obviously positive, but the number before that comes in was the retail sales. Now this is where a lot of traders are actually pretty baffled with what's really going on, because we have a week where the US dollar was pressured lower, and then all of a sudden on Friday it kind of reverses, even though the retail sales number was actually low. And the reason for this is that the data so far that we are looking at, or traders are focusing on, was the monthly numbers. Now if we take a look at the monthly numbers for the retail sales and the core retail sales number, it was down negative 0.2 to negative 1% for the monthly retail sales. Core retail sales was down 0% to negative 0.8%. Both are beating consensus of negative 0.4%. And the reason for this is that if we tally up the January numbers and the February numbers to form what the quarter is going to be, it's still going to be more or less an upbeat quarter, right? And because we have that data for the first 3 months in 2023, we are going to be looking at quarterly GDP numbers coming up next month. So it'll be interesting because despite all the negativity around the US dollar itself, the US economy is actually not doing that bad. And with how the FOMC is saying that they're willing to risk the market going into a potential recession, but they're still going to be focused more on fighting inflation, and the concern that if there's any further contagion from the banking crisis in the US, it could lead to that borderline recession at the end of 2023. Market is right now pricing in for a 25 basis points hike in May, right? This is about 81% of the consensus that's saying there's going to be a 25 basis point hikes in May. So from my opinion, I think a 25 basis points hikes is actually still going to be in play. In terms of whether or not interest rate target is going to get adjusted, I think it really depends on the next CPI numbers. Is there going to be any improvement? But this is a huge drop. That 1% drop is a huge drop, and this is going to get brought up during the FOMC meeting. Once they hike interest rate, they could be stating that because the inflation has gone down significantly, they might actually take a pause from that 25 from further interest rate hikes. But in terms of whether or not there's going to be an interest rate cut, which is what the market was speculating, and which is the reason why the US dollar was getting pressured last week, I don't think that's going to be in play, because I think the focus for the FOMC is going to be fighting inflation, and to do so, it's not so easy to just start cutting interest rate just because the economy needs more room to do that. I think the FOMC has enough to say that the U.S. economy is pretty strong, it's pretty resilient, that they don't actually need to cut interest rate, but the focus is going to be that 2% inflation target from the FOMC. All right, so that's just news coming up from the US. And we've got Canada holding at 4.5%, no interest rate hike. Again, it's going to be data dependent going forward, unlike the RBA, where the pause is probably apparent until about July to August, which we're going to find out more with the RBA meeting minutes that's going to get released on Tuesday this week. Then we have the Aussie unemployment numbers. It was slightly better, from 3.6% to 3.5%. And then we have the UK GDP numbers. UK GDP was basically a 0% growth. This is below consensus of 0.1% growth. But again, we're not really focusing on the monthly numbers. We're just so close to the quarterly numbers. The reason why the quarterly numbers is important, because what decides an economy into a recession is going to be the quarterly GDP numbers, and that's basically the main focus going forward into the future. All right, so those are the data last week, which is a very interesting week because it changed a lot of the dynamics in the market, and we're going to talk about that during the technical side of things. Okay, so for this week, on Monday, we've got the Empire State Manufacturing Index. On Tuesday, we've got the UK claim and count change, as well as the RBA meeting minutes in the morning. And then we have the Canadian CPI numbers. We're going to be focusing more on the trim CPI or the core CPI year on year for the Canadian market. And then we have the UK CPI. This is going to be the big event for the week. And the UK CPI, if we take a look at the consensus, is actually 9.8%. This is the same consensus that we saw last month at 9.8%, but instead of getting that drop towards 9.8%, the inflation number actually went up from 10.2 to 10.4%. So again, the consensus at 9.8% does show that the economists and analysts are really anticipating that drop below 10% for the market. So if it's still above 10% and we didn't get that 9.8% on the drop on the inflation in the UK, I think it's going to be a tough time for Bank of England, because they were planning to pause interest rates and stuff like that. Doesn't really leave them with a lot of room, and they're still going to have to continue hiking rates because the inflation is still out of control at above 10%. If it does meet consensus at 9.8%, I think there's going to be a lot of whipsaw in the market. It'll create a lot of confusion. If it's above 10%, that's still going to boost the sterling, because the Bank of England will need to continue hiking interest rate aggressively because right now inflation is still not under control, unlike the situation in the US and the Eurozone, where it's starting to fall down. If we do get a number that's below 9.8%, I think the trigger point would be 9.5%. If we get 9.5%, I think that's going to impact sterling negatively. So we'll see what happens with the UK CPI numbers. But this is really key because comparing it to the US and the Eurozone, the UK CPI is still really high, above 10%. Okay, and then on Tuesday, really nothing much. We've got quarterly CPI numbers coming up from New Zealand, expected to jump up from 1.4 to 1.5%. I don't think it's going to be a huge impact because New Zealand RBNZ has already hiked 50 basis points this month. So, you know, they kind of anticipate this to happen. The U.S. unemployment claims expected to bump up a little bit from 239,000 to 240,000. This is the weekly unemployment claims, by the way. And then on Friday, we've got the flash manufacturing and services PMI coming up from the Eurozone, the UK, and as well as the US. I think the focus for this one here is that if we take a look at the numbers here, the anticipated numbers, whether it's going to be an increase or a decrease, the manufacturing numbers are generally still below 50. And that's kind of the trigger point here, because 50, anything above 50 means an expansion in an economy. Below 50, we'll be looking at a little bit of a contraction. So manufacturing numbers, I think they're still going to be below 50. The services PMI numbers, they are already above 50, and you know, as long as they're above 50, that should be okay. So closer attention should be paid for the USD, because if you take a look at the numbers, the flash manufacturing numbers last month was 49.2. The ISM manufacturing number was actually 47. It was actually below the consensus. So this one here, the flash manufacturing expected to drop a little bit to 49, right? So again, flash manufacturing numbers, it could get severely affected. Are we going to be looking at a number below 49, or are we going to get that surprise above 50? If there's going to be that surprise above 50, then that's going to be another huge boost for the US dollar. Services PMI should be okay as long as it's above 50. Keep in mind that the US economy, it's 30% manufacturing, 70% services. So the services number, we're kind of in the safe zone for the services number. Okay, that's for the fundamentals previous week and this week. So let's take a look at the technicals. A few interesting things to point out here. So we have the dollar index. This is coming off the oversold condition. We did mention the key level is going to be 101.50, but if we take a look at the low at the beginning of February, it's actually at 100.82, and we have actually seen a double bottom on the dollar index here, and price is currently trading above 101.50. So we might actually see a little bit of a floor for the dollar index. With that in mind, do we anticipate a little bit of technical correction for the dollar? It could be possible if we see that. Any move above 102, that would likely confirm a little bit of a technical correction for the dollar index as well as the US dollar. With that, take a look at the Aussie USD here. Aussie USD, we had that fall on we had that rejection on the 38.2% Fibonacci retracement at about 68 cents. That happened on the 4th of April. And then we have that move on Friday where we have that rejection again at 68 cents, right? So we have seen that confirm as a resistance. I think the overall tone for this one here, because we have that bearish flag pattern that was broken, we didn't really exceed and created a new high for the Aussie USD here. Price is currently finding support at about 67 cents. That's kind of where the pivot level is. The pivot level is actually 67.10. So price actually opened below pivot level this week. So it might actually be an indication we could actually see further weakness on the Aussie USD. If the RBA meeting minutes does point out tomorrow that the RBA might take a few months to pause and assess the current situation in the market, that could be a negative driver for the Aussie USD. So should there be a daily close below 67 cents, now this is going to be your immediate support level. Any close below 67 cents would trigger a further drop to the downside. We've got support at 66.25, 66, and then 65 cents on the Aussie USD. For the Euro USD, as I changed, the dynamic has shifted a little bit in the market. Because of that lower than expected CPI number, which is a full percentage drop, that pushed the euro outside of its resistance range, which is 1.0850 to 1.09. As of time of recording, which is on Monday, The market is actually has opened the week above the pivot level, the weekly pivot at 1.0970, right? Take a look at where the resistance levels are located. It's actually located at 1.11 and 1.12. We've got a 127.2% Fibonacci extension coming in at 1.1175, which is very close to resistance 2 on the weekly pivot. Now, for as long as price doesn't actually close below 1.0850, we might actually have that opportunity where the Euro USD could continue to push higher, and the Euro USD it is one of the stronger currencies. Even compared to the sterling, the Euro pound is gaining significantly against the sterling, so the Euro, it's in a different scenario, right? The ECB is still going to be hawkish. They're still going to be hiking interest rates. I think the market is just questioning whether it's going to be a 25 basis points hike or is it going to be a 50 basis points hike. Regardless of the matter, the Euro USD has that potential for further move to the upside. In terms of support, I think we should be paying closer attention to 1.0850 and 1.09, and considering what this level was, it was a key resistance for the pair basically in late last year, in January and then in March. So we should anticipate more support coming in at 1.0850 to 1.09, just in case price drop down below the weekly pivot. Otherwise, any move back above 1.1 that could trigger further rise on the Euro USD towards 1.11 to 1.12. So we are looking at a little bit of a not a positive correlation on the Aussie USD and the Euro USD as well as the Pound USD. So the Euro is actually in a very different scenario here. Next up is the Pound USD. The Pound USD, technically, it still fails at 1.2450, 1.25. We have seen that drop on Friday. That takes the sterling opening up the week below the pivot level. Last week we were anticipating a little bit more of a pullback towards 1.23, and I think that's likely going to be what the scenario is going to be for this week. If you take a look at where the support one is on the weekly pivot, it is located around 1.23. So the best scenario for Pound USD is actually for this one to correct itself to 1.23. In terms of whether or not it can gain a little bit higher in the future, basing it just on how it looks, it's technically still in an uptrend. We're still way above the Ishimoku cloud. We continue to post a new high. Last week was definitely a new high for the pair. It actually managed to break through above 1.2450. It's just that on Friday it kind of takes this down a little bit. It closes below 1.2450 again. So we're looking at a few scenarios here. You go support at 1.23. If that support holds, then I think we're going to be looking at buyers. If that doesn't hold, and then the pair could actually retrace to 1.22 and 1.2150 and still be in an uptrend. So it's just really a matter of whether or not 1.23 holds. If it doesn't hold, then we do anticipate a little bit more of a deeper pullback, likely towards 1.22. Okay, the alternative scenario is that we don't see a pullback, but price continues to break above 1.25 on the daily time frame. That would be another driver for the Pound USD. Next up for that, if there's going to be a case of a close above 1.25, would be about 1.26 and then 1.2750 on the Pound USD. Okay, the dollar Japanese yen, this one here, we got pivots at 133 yen. We've got support one at 132.50. Right, and in terms of where price is currently, it is within the Ishimoku class, where we do anticipate a little bit more of a slow grind. This is something that I mentioned last week, that we do anticipate a little bit more of a slower grind towards 134.50. Again, the dollar yen needs to break above 134.50 for it to actually be a little bit more free. Once it is above 134.50, again, as per previous outlook, there's really nothing much above 134.50 until about 137. All right, so we got two key support level, 133 and 132.50 for the dollar Japanese yen. Any break above 134.50, that could send the dollar yen really high to the upside. All right, next up, it's oil. Oil, last week we discussed about the OPEC supply cut, all right, 1.16 million barrels, and then we saw price jumped up and then pauses, right? When price pauses, I kind of gave out two scenarios. One is either we see that pullback towards $77 to $78, or the other scenario would be a break above 82, and we are on the second scenario. So we have seen price break above 82, went up all the way to above 83, where it kind of stabilizes about 82, right? So we're looking at buyers coming in to support the price at $82 right now. Given today is Monday, if price is able to maintain that position on above 82 on Monday and Tuesday, it would likely reset the short-term momentum. We might actually see more buyers in the market. With that in mind, I think oil is still projected to go higher. All right, and in terms of projections, we have $85, $86. Beyond $85, $86, we've got $90 to $92 on the US oil. Okay, let's talk about gold, because I think a lot of people are interested in what's going on with gold. So with gold, the warning was there was a Class A bearish divergence, and then on Friday's close, if you take a look at Friday's close and the close the week before that, we've got a slight doji the week before that. On Friday's close, we have a full bearish engulfing. Now, despite all the bearish sign here, one level that you need to keep in mind is actually 2000, right? So 2000 is still going to be that special number where we see buyers thinking like, hey, this is a good price to jump in on gold, right? So we might actually see buyers coming in at 2000, but any break below 2000, that would lead into a technical correction that would send the gold lower. We've got support in 1980, 1960, 1950, 1940, 1920, and then ultimately 1900. So there's a lot of staggered support for gold here. So this one here is a little bit unique, right? There was some arguments with the whole rise in gold. The whole rise in gold, I think it's more on the thought that the Fed might be cutting interest rates. So this is more of a speculative move. The fall in that huge drop in that CPI numbers, if it has such a negative impact on the US dollar, if the market has so much confidence on that because of the CPI number, that there's going to be a rate cut in 2023, it should have sent the gold higher and create a historical high. Well, we haven't seen that, so I think we should be a little bit more cautious. So I'm not too bullish on gold at the current level. I like to see a close below 2000 before I would initiate a little bit more of a sell towards a correction. I think gold, it's in a severe state of potentially initiating a deep correction that could actually be a shock to the market. Okay, so I think a lot of people are still going to be positioning themselves at 2000, so I wouldn't actually be doing anything much on gold until I actually see that 2000 level be taken out and we have that drop below 2000. Then yeah, I would trigger a little bit more of a correctional short on gold. But other than that, it's going to be a little bit tough for gold here because it's kind of in that uncharted territory at this point in time. We don't know if the move last week was really speculative or anything like that, but the sudden reversal, that quick sudden reversal on Friday, taking it back $40 within one day, I think that's a significant drawback for a lot of people, and it should be considered as a warning sign. All right, so with that, good luck for your trades this week, and I'll see you next week.